All attendees are in listen-only mode.
Hi, my name is Mark, and just a little bit about myself. I'm a graduate of the University of Pennsylvania. I'm a former professor at Jefferson University in Philadelphia, PA. I've been involved in the financial markets for over 20 years, and I began trading the futures Forex markets about 10 years ago. Now, I got involved in the optimization of multivariable equations as part of my thesis, which involved the optimization of a multivariable equation which described underwater decompression schedules for deep sea divers. At the time, undergoing underwater decompression was a really dangerous and laborious task. As you come up from a deep sea dive, you have to change gas mixtures, and you have to wait at different levels as you come up. And the optimization of that problem had never been attempted before via computer. And this was back in the day when there was only one computer in the entire United States, and that was at Penn. And that's how I first got involved in that. And that was my honors thesis, using ASOP, the Automated Engineering and Scientific Optimization Program. And that's where I got involved in optimizing multivariable equations. And right now I'm with Right Line Trading, and we're at www.rightlinetrading.com. Now, before I even go into the stochastic oscillator and Renko bars, and if you've come to one of my webinars before, some of this is going to be redundant, but the point I make, I think, is really very relevant and applies to everyone who tries to day trade and or swing trade. It's not relevant, I think, for long-term trading, and that is, last week I went to the library here at the University of Miami, and I did a Medline search for day trading, and what was pulled up was essentially just a handful of really lousy articles about day trading. And what they did was they described day trading, but there was no scientific paper to describe the methodology that is most effective in day trading. So essentially, the science of day trading doesn't even exist. If you do a Medline search for architecture, you do a Medline search for medicine, you do a Medline search for almost any other scientific endeavor, you come up with thousands and thousands of papers that have proven specific scientific relationships that allow that specific endeavor to move forward. I mean, take for instance, shooting a rocket up into space. I mean, none of the associations or relationships that go into the sophisticated electronics are done empirically. They're all done after an enormous amount of scientific testing. But then when we look at day trading, we find that there's almost nothing published. People take, essentially what people are doing is they're taking a priori to be true what they're told by other people who have received their information from other people, and it's sort of like uh, playing telephone when you're a kid. You're simply passed along information from generation to generation about information that's never been proven to be accurate or proven to increase the precision of your trading. There's no science to day trading. Now, if you look at the failure rate of people who day trade, it's generally accepted that 95% of all day traders fail, and that of the 5% that are successful, 2 to 3 of that percent simply are on a treadmill and just churn their portfolio. And really only 2 or 3 out of 100 traders who move into the day trading arena ever consistently make money. And yet we just continue to plow forward, and that statistic never gets any better. And it's really just amazing how bad or how high the failure rate is in this endeavor, and nobody seems to question why. I mean, why is it so hard to day trade? Why do so many people fail? And I think the answer to the fundamental question is that people are using indicators and using relationships that have never been proven to work, and they don't work, and they're applying them, and when applying them to day trading, they fail. And if we look at all the software that comes out, the new software, the upgrades, the variations on a theme, the new indicators, areas of absorption and whatever, zones of this and zones of that. Really, they're all variations on the same theme. I mean, there really isn't anything new. And essentially, again, they're relying on relationships that have never been proven, and they don't come with any proof when they're proffered to us to purchase, to use, to trade our money. And to give you an example, let's look at the stochastic oscillator and Renko bars. And what we've done at Right Line Trading is we haven't taken anything for granted. Like, just because we're told that an oscillator defines an area of an overbought or oversold, an overbought or oversold market, we don't take that to necessarily be true unless we prove it ourselves. Now, the stochastic oscillator, it's a momentum indicator that shows the location of the close relative to the high or low range of a set number of periods. And if we look at the formula for the oscillator, you see that it requires 4 numbers to crunch out an appropriate percent K line. We need the high and the low of the current formation, and we need the open and the close of the current formation. Now, if we don't have those 4 numbers, the percent K line is not going to be accurate. But yet, I see over and over again, so this is just a regular stochastic line, and it's an accurate line. These are range bars, and they have a high and a low and an open and a close. So the stochastic formula is able to pull all of the 4 relevant numbers out of price movement and trace out an accurate line. But what I see in multiple software platforms is the use of Renko bricks with a stochastic. Now, if the producers of the software knew anything about the formula for the stochastic, they would understand immediately that the stochastic line doesn't work. It's simply tracing out the shape of price, because the Renko brick has a high and a low, but it doesn't have an open and a close. So it's missing 2 of the 4 numbers that's required in order to produce an accurate percent K. So right there, anybody using a stochastic without an open a high-low, open or a close, is using an indicator that just isn't going to work. So you have to know a little bit about the mathematics of the indicator in order to ensure that whatever type of formation you're using is providing it with sufficient information. And a formation can be a Renko bar, it can be a range bar, it can be a tick bar, it can be time bar, it can be an open, high, low, close. All of those work fine, but Renko bricks do not work. Now, again with the oscillator, if an oscillator signal is going to have any predictive value in determining how to use it to trade, then it's got to mean the same thing to everybody. Some people can interpret an oscillator signal one way, and other people can interpret the oscillator signal another way. But with an oscillator, you have two groups of people, and each of those groups interpret it in an absolutely different way. There's one group of people who say that when the market is overbought, when the oscillator crosses that 80% line to the upside, it shows that the bulls are firmly in control of the market. And what happens is they continue to buy each high pivot as the market breaks the high. Eventually, the market's going to run out of steam. It won't break that last high pivot, and that's where they exit. So what they do is they use the oscillator to tell them when to go long, and they use it based on the fact that the oscillator is telling them the bulls are in control of an overbought market. Then you have another group of traders that use it to actually define an overbought or oversold market. So they're looking for it to tell you when a reversal is going to occur. And they look for stochastic divergence, and this can, it can be MACD divergence, but that's when the RSI makes a lower high, but price makes a higher high. And this is divergence. You would go short on this candle. But what happens is you can see that the market, the entry just immediately gets overrun. So you have two groups of people interpreting an oscillators in exactly the opposite way. And then furthermore, depending upon which way you determine that an oscillator is supposed to be traded, you have to forward test it for 2 years to determine if the oscillator signal has any predictive value whatsoever. And that's what we did here at Rightline. We simply ran multiple markets forward for 2 years on market replay. It takes about 3 days to do forward testing per year, so 6 days for 2 years. And what we found was that a stochastic signal, i.e. if you define a short signal or define a long signal based upon the shape of the percent K, it has no predictive value whatsoever, or the predictive value is so low that in no way will it enhance the precision of your trading. And when I say predictive value, in the sense of positive predictive value, I mean the sensitivity, which is its ability to ferret out true positives, its specificity, which is its ability to determine true negatives, and then its ability to determine prevalence. And we'll talk about prevalence in a bit, but sensitivity over specificity times prevalence gives you the positive predictive value, or essentially is the signal that the indicator provides you worthwhile. Now, we're all told that an oscillator signal, it's standard dogma, that an oscillator signal is a valuable indicator. But what we have found is that it's not a valuable indicator. Now, I don't have a slide for this, but we're working on the MACD, and what we're finding is the same thing, is that the MACD crossover doesn't have sufficient predictive value to provide it with the power to give you a trading signal to take the market to the long side or the short side. And we're trying to build a science of day trading here and not take anything for granted. Everyone's taught that a MACD crossover is a significant event. And everyone is taught that if it is in line with the higher time frames in an attempt to add specificity to the trade, if it's in line with the time frame on your trading chart, you get a MACD crossover, then you can trade the market to the upside if everything is aligned long. But the fact is that the MACD crossover to the upside doesn't enhance the positive predictive value of a trade. And so one by one, we're looking at these indicators and we're finding that people are using these in a manner to help guide them with their day trading. And yet they're just as often providing you with misleading signals as they are providing you with accurate signals. So they have a negative predictive value, which sometimes is higher than their positive predictive value. So that's a big, big problem. And one that I throw out to you just in general as the reason why so few people make it successfully in this business. I mean, they use software that's based on the same old, tired, dogmatic principles that have never been tested scientifically. And when they are, they show that they don't work. And people are constantly coming out with new software versions based on the same tired old principles. And if you buy the software and you trade it, you cannot make money. Now let's look at Fibonacci, because we did the same thing with fibs. Now Fibonacci, a lot of people just believe in it as a religion. They believe that Fibonacci extensions and retracements will define market movement. And for the life of me, I have no idea why they do that. First of all, I mean, Fibonacci is a mathematician, I don't know, was around in the 16th or 17th century before the stock market was even around. Now, although I know that Gann theory and Elliott wave theory don't work, at least those theories were made to try to describe price movement in the market. Fibonacci, as a mathematician, didn't even have the stock market around at the time that he developed his Fibonacci transformations. Now, in Fibonacci transformations, I mean, the Fibonacci numbers are interesting, and in nature they define how many edges there are on a snowflake, and how many rows are going to be on a popsicle. I'm only kidding. On a pine cone, you know, they do predict some things in nature, but the real sophisticated equations predict very sophisticated movements. Like we have equations that describe the interaction of subatomic particles. We have equations that describe the interaction or the relationship between matter and between energy. All these relationships describe many things that occur in nature, whereas where Fibonacci transformations really describe nothing. They're simply nothing more than a mathematical curiosity, and professors who do research and math don't use Fibonacci for a thing. So what we did was we put Fibonacci levels into a chart, and we looked at the predictive value going forward testing for 2 years, multiple markets, and we found that Fibonacci levels are just as often going to break as they are to hold. And if that's the case, they don't have any predictive value. So the predictive value of Fibonacci is so bad again that it almost has a higher negative predictive value than it does have a positive predictive value. And the reason is, if you go into Medline, if you go into the multiple other databases. You do a Nexus Lexis search, a world search for all the literature that's ever been published and indexed in any kind of authoritative journal. You will never find a single paper that describes the accuracy of Fibonacci in describing price movement in any single financial, using any single financial instrument. Now, without having that, why would we even consider using Fibonacci to help us day trade? Without that information, or with that information not existing, we're not going to use it. And what we have found here is that 2 years of forward testing show that Fibonacci extensions and retracements just don't work. So we haven't gone by what our fathers told us and their grandfathers told them, metaphorically here in terms of day trading. We've defined our own set of rules, and we've looked at what works and what doesn't work, and not taken anything for granted, and fibs are out the window. And that's not arbitrary. It would be great if they worked, but unfortunately they just don't. Now think of a platform that uses Fibonacci, that uses a stochastic, and that uses MACD to try to help you get a precision-based entry. I mean, you're doomed if you're going to base it on those three indicators. So the important thing is that you have to know the predictive value of any indicator that you use. And the one thing, I mean, I go into other webinars, and the only question I ever ask the software vendors are, what is the predictive value of your trading signal? I.e., what is the sensitivity, what is the specificity, and what is the positive predictive value of the trading signal? And if they don't know it, then you should really run in the other direction, because it may be a great piece of software, but they can't proffer it to you as being great because they don't understand or know how likely you are to get a winning trade when their software clicks off a signal. So what is the predictive value of any indicator that assimilates data from your trading chart only? And what is the predictive value of any indicator that works sometimes but not other times? And essentially, the predictive value isn't zero, but the predictive value is so low that it's going to really hurt you far more than it's going to help you. And essentially, this is why 90% of day traders fail. They don't ask the right mathematical questions. And unfortunately, we take a lot of information that other people consider to be dogmatic and true, and we just also internalize it and believe it to be true as well. But we can't do that because, let's face it, this endeavor is broken. I mean, if 95% of buildings that were put up by construction, by architects and contractors fell over, we wouldn't have any buildings, and no one would be trying to put them up. If 95% of all the patients that went into a hospital died, no one would go into a hospital and there wouldn't be any medicine. But for some reason, we accept a 95% failure rate in this endeavor and never question why. Now, if 90% of commercial traders fail, where is the money going? And what we're doing is we're giving it to the institutional guys. We're giving it to the big money guys. And there's no reason why we can't outcompete the other commercial traders. There's no reason why we can't be the people that make money 95% of the time by beating out the other commercial guys and trading with the institutional guys. Why is everyone giving all their money to the institutional, to the big institutions? And that's what's happening. Now, what we've done, and here's another thing that's really important. If the system cannot be electronically traded, if it cannot be described by a multivariable equation, the multivariable equation subsequently optimized and traded automatically, then the system has no value. If it does have value, it can be electronically traded or traded algorithmically, which is even better. Now we have an electronic algorithmic system. Now, what is so powerful about it? I'm going to show you the results we have. We've only had it operational for about a month and a half. And we started on 2 markets, then we went to 4, then we went to 6. Now we're on 7, and soon we'll be on 8. And I'll show you what happened today when I blew the fuse on the algorithmic system and cost us 2 winners. But an algorithmic system, our system will trigger automatically on your NTD platform, which is provided to you. I call out the discretionary trades, and so we use a combination of algorithmic and discretionary trading. So let me just hold up on this slide and move over to the to our platform. So hang on one sec. Let's take a look at crude oil today. Now today we made $560 in the trading room, and we use Chart Trader, and we show all of our entries and all of our targets, and everything is projected right into the room. We try to be as transparent as possible. Now let me just say one more thing about discretionary trading versus algorithmic trading. The problem with discretionary trading is a lot of relationships. Well, first let me say this. Hold on one sec. Let me go back to the slides before I can do this. I'm sorry. I don't mean to drive you crazy here, but I want to just show you a couple of the indicators that we've really come to rely on heavily. Now you'll notice here, this is background bias. Now, we don't believe that any indicator that assimilates data from the trading chart has any value whatsoever, or any predictive value whatsoever in defining a precise entry. And a lot of these software programs give you zones of this and zones of that. Zones are all well and good for getting out of a trade. I mean, if you're coming into an area where there's a pivot, where there's an area of upside resistance or downside support, you want to get out. But zones do not help you get into a trade. You need a precise numerical value to enter a trade. You can't enter it from a zone. Now, what the background bias does is define the direction of the higher 2 time frames and project it onto your trading chart. So the reason that price is falling here is not because the falling price creates this pink. The pink telling you that the higher time frames are heading down. It also tells you that all support to the downside is broken, makes it statistically highly likely that price on your trading chart is going to fall during the period of time that you see pink in the background. This particular variable, this particular independent variable has significant predictive value. If you use this as an independent variable in your trading and you trade short during a period of time when your 2 higher time frames are moving to the downside and all support is broken to the downside, a short trade is much more likely to be successful. So the background bias adds precision to your trading and enhances the predictive value of a trade. This is an example of an indicator that does work. And I just wanted to show you another indicator that works. And this is really a fundamental part of our algorithmic trading system. And that is that we can do multi-market analysis. Now, this line has absolutely nothing to do with any price on bond. This is ZB. This is bonds. price on bonds has nothing to do with these lines. There are three markets that are factored into each line, and these are correlative markets. These are markets that either move up with bonds, when bonds move up, with a correlation coefficient of 0.7 or greater, or move down when bonds move up, with a correlation coefficient of 0.7 or greater. So what they're telling you, what the quant lines are telling you, and the reason we call them quant lines is that we quantitatively weight each of the markets. The ones that have a correlation coefficient of 0.9 are weighted heavier than the ones that have a correlation coefficient of 0.7. What they tell you, though, is that when the line is green, money is flowing into bonds because it's flowing into all the correlative markets that go up when bonds go up, and coming out of the correlative markets that go down when bonds go up. So these two lines, again, also significantly enhance the positive predictive value of getting a trade. And the quant lines on bonds are very, very powerful. When both these lines are green, there's a tremendous tendency, because it's essentially using multi-market analysis, we're looking at money flow. Now, even with one yellow quant, you see how the market tends to go sideways. Two yellow, money is simply equilibrating between these different markets. Second quant line is green here, pushes the market up a little bit. But when you get both quants green, a market just fires up. And it's not price on your trading charts that's creating these green lines. These green lines are looking at markets that are totally independent of bonds. They don't even care what bonds do. So this indicator, in conjunction with bias, provides you with two tools to markedly enhance the precision of your trading entry. And you'll notice there's no stochastic here. There's no MACD here. They're not going to help you. We're looking at the analysis. We're looking at multi-market analysis, and we're looking at higher time frame analysis, along with the analysis of support and resistance on your higher time frames. Here's the other indicator which significantly enhances the precision of your trading, and that is market profile. Now, our market profile is proprietary. It doesn't analyze data from one time period. It does a proprietary look back. So it has significant value even at the open of a given market. And this is the value area high, this is the value area low, and this is the point of control. And price tends to want to stay in between the two value areas. And when it breaks out and then comes back to test it, it's a great time to take a trade to the long side. When you break through, come back, and move up. It's one of the things that we look for, is a break and retest. Now, the point of control is the area where price and volume are the highest. This is where price likes to sit, because this is the area, this is the single price value where there's the highest volume. So the point of control sort of acts like a magnet. This is where price likes to be. It's a strong area of resistance to the upside and support to the downside. We trade it just like we do the value area high and the value area low. We look for a break and retest, but it's always got to be into the trend. We want our quant lines to be with us. If we have one quant, we want it to be green. A lot of our markets have two quants, we want them to be green. And a lot of our markets have three quants, in which case we want all three quant lines to be green, and we want our background bias to be green, telling us that our two higher time frames are moving to the upside, and we've broken all resistance to the upside. So you can see how we're slowly defining a more and more precise entry based on indicators that we have tested and know work. And again, there's no stochastic and there's no MACD. Those are not going to help you. Now here's a market structure. Now we're very, very big market structure advocates. And our system reads market structure. And one of the most powerful types of market structure setups is consolidation. And when the market moves into consolidation and the power of the bulls and the power of the bears is equal, price is going to trend laterally until it hits resistance to the downside, and then the market tends to shoot to the downside. And here you have the 50 down and you have the 15 down. Now, our algorithmic system reads market structure. It reads consolidation. And one of the strongest trades that it will take is a short trade at a consolidation off of resistance to the downside or off of support to the upside. That has a predictive value that's very, very high. I'd say between 85 and 90%. But remember, it's got to be with the trend, and the algorithmic system is also reading the quant lines, and it wants both quant lines to be read. And that's the difference between discretionary trading and algorithmic trading. It's one of the differences. You may decide to take this consolidation trade because it's so powerful with only one red out of two quant lines. You get, that's your discretion. You don't have to have every single metric that goes into optimizing a trade in your favor. Maybe you want to give away something because you know that the power of a consolidation trade is so great. Well, the algorithmic system won't do that. It won't give away anything. So you're not going to get a trade unless all the quants are with you, unless the background bias is heading down in the same direction as your trade on your two higher time frames. You've got your 50 red and you've got your modified 15 red. Those are the only kind of trades it's going to take. Now, this is a break and retest, which I don't want to. Okay, now I'll just go to the algorithmic performance before I go to the charts. Now, this is the algorithmic performance based. I put 4 contracts. It doesn't really matter how many contracts we have. It's based on our ATM. We have a total of 20. We've taken 24 trades. We have 20 winners and 4 losers. That's a win percentage of 84%. On crude oil, we've had 7 winners and 2 losers. On the E-mini, we have 9 winners and no losers. On bonds, we have 1 winner and no losers. On treasury notes, we have 1 winner and 1 loser. On gold, we have 2 winners and no loser. And on the NASDAQ, we have no winners and 1 loser. That equals 20 and 4. Now, I didn't go into numbers, but if you are trading a $5,000 account, the algorithmic system has been running for 6 weeks. And the system has only had markets 3, 4, 5, 6, and 7 operational for about the last 3 weeks. So it was really trading on only 2 markets earlier. And since I was trading those markets, I nullified a lot of the algorithmic trades by taking them on a discretionary basis, and the algorithmic system won't hit an entry if I already hit it. So we really couldn't road test it as hard as we could. The number of entries we're getting is going up higher and higher now that we're diversifying the number of markets. But just in this short period of time, the return on investment is 50%. You made about $2,500 on a $5,000 investment, and you don't have to do anything. The algorithmic system takes the entry and manages the trade for you. Now, we've just added natural gas, and it's had no trades. It's only been operational for a few days. We had heating oil, but we don't like it. When we forward tested it, the positive predictive value of the entries were not as good as we liked. We don't use it. And we already tested the 6E. It looks great. The Forex looks great. And coming soon will be the 6E, and coming soon to the Forex. But looking at the algorithmic system as a source of an investment, if this can consistently return 50% on your money per month, it's an incredible tool. Now, the system not only gets you into the trade based on the average true range of the market, it adjusts your targets. And I don't know any system that does that. If the market's very volatile and the average true range is big, it will actually extend out your distance to your first target and your second target. It's going to give the trade more of an ability to run. When the average true range of the market narrows, it's going to adjust down. So it's a self-adjusting system when it comes to trying to milk the trades for as much money as we can. And so far, it's doing awesome. Now, I'm going to show you some of the trades. They're so conservative, and they require so many independent variables that we know need to be present for a winning trade to occur. And the fact that the targets are self-adjusting makes this a durable, long-lasting system. Now, I just want to say one more thing about algorithmic trading versus discretionary trading. If you define all the independent variables that go into obtaining a successful trade, the relationship between each of those independent variables is nonlinear. And let me try to give you an example here. All right, let me take out the slides. Let me just show you. Let me show you the market. Now, it's that nonlinear relationship that causes discretionary trading to sometimes run into problems. Now, over the course of 30 months, we only had one losing month and very rarely had a losing week. But for 3 weeks in February and for a couple of weeks in March, we had a very difficult time because a lot of the more aggressive trades we took that were working for a long period of time, they just stopped. And so we had to take a much more conservative approach. That's why we made $560 today. We've made money every single day this week in the trading room. And I'll show you the trades that we took today. And this is just a description that I wrote. But in the trading room, we had this trade, and this was just a move up. It was a retracement. You see the candles outlined in green? That tells you that order flow and momentum have aligned with you to the upside on the two higher markets. But look at your key indicators. The modified 15 is green. The 50 is actually yellow, which is fine. The 50 as it slopes is a marker of momentum. You know that order flow and momentum are aligned to the upside on two higher time frames. Your entry is one tick above the trade, one tick above the close of the candle, and we're up for 18 ticks. And you can see we had plenty of room to the value area high, nothing to impede the trade, and up we went. Now, this isn't a very aggressive trade. This is a trade on a rising channel. And I saw the trade, and I was almost going to take it, but I said to myself, I'm not going to do it because of how difficult the market's been, and it turned into a winner. You can see the C candle comes right off the value area low, and this is a much more aggressive trade that's not in the algorithmic cookbook. This trade is in the algorithmic cookbook and is an algorithmic entry, but I took it. So I stole it from the algorithmic system. And then we had this trade to the downside. This is a little more aggressive. The move to the downside, then the upside. Whoops. Then the move to the downside for 10 ticks. And this is a big discretionary trade because I didn't have the quant line with me, and I didn't have background bias with me. So the higher time frames were not aligned to the downside, and the 50 was moving up. So it was a much riskier trade, but my 15 had crossed the 50, and down we went for 10 ticks, and you can see it's bouncing right along the point of control and having 1 ton of trouble getting through. So if you took a trade into the point of control, you'd have multiple losing trades here. Now I had one more winner. I don't know. I can't find it. I don't know where it went. Oh, what was it? It was here. I took this move up, the retracement, right to the point of control. 5 ticks is our first target on the discretionary system. It went 6. So it went through the first target and gave everyone a first target. And let me show you this. I'll show you the E-mini today. We had no trades in the trading room because the E-mini was a mess. Now the quant lines on the E-mini are really, really important. They look at 9 correlative markets, and you really want to trade the E-mini when you've got triple green or you've got triple red. And if you look at the market open and you just look at the correlative markets, I mean, it's horrendous. And the only place I could find a potential trade was right here to the upside. This isn't going over the charts with people in the trading room, but it was a mess. And I didn't take the trade because it was right into the value area high, and it worked. But that's when you trade with precision, you don't get all of the trades. But the ones that you do get, you hope work. Now this is after the trading room closed, and you can see how an entry to the downside when you have background, and this is a really good background color to the downside here and here. And they're both retracements and moves down off the value area low, down. And right here, even though we define, I don't want to get too complicated, but we define overbought, oversold in a very, very specific way. Now that algorithmic system, I'll show you what it did today. Now I made a really, really big mistake today. What I did was I saw that natural gas was trading on the wrong front month. Let me find the I have to find the chart. So what I did was I rotated the natural gas month in the middle of the trading day. And by rotating that front month contract on natural gas, I torpedoed the algorithmic system for the entire day. And the algorithmic system had 2 entries right here. If we go to the right edge, you can see now the algorithmic system, in order to get a trade, has to have this dark pink or this dark green background. The 15 has to be down. And the 50 has to be down. These are all independent variables that specifically impact on the success of the trade. And we don't trade into support or resistance. But there was enough room here for another entry. And you can see what happened. So what I did was, this was an 11-tick entry. The system didn't fire because I had shut it off by mistake. Whoops, I'm giving this an extra tick. And this was an 8-tick trade. So I don't know how it would have handled the trailing stop because it does vary, but it blew us out. I nailed 2 gold winners right here. So instead of being 20-4, it would be 22-4, and gold would have 2 more winners on chalked up for it. So I just want you to see a little bit of the power of the algorithmic system. Now, the other thing, remember, is not when you trade with specificity, you also want to be able to avoid the losers. And when there's chop in the market, the algorithmic system just is awesome for avoiding chop. It just doesn't take a trade because it needs so much to be aligned. Now, I'm just going to show you, and I want to show you one other thing, because I really want to make this as let me just bring crude up on the charts that I use, because the ones that I use are a little bit different than the ones in the trading room, but not very much. Now, what we're doing right here is we are testing a multi-time frame analysis of momentum, looking at multiple, each of these lines is assimilating data from 2 higher time frames for the MACD. And when the MACD crosses to the downside, the line turns red. When the MACD crosses to the upside, the line turns green. That's one line. That's our 2 shorter time frames. When the 2 longer time frames, it's MACD's cross to the downside. When it crosses to the upside, the MACD turns blue. So we can see how the MACD behaves on 4 separate time frames just by looking at our trading chart. And I can tell you it's useless. And I'm looking at 4 separate MACDs. If you use this to define a trading entry, it doesn't give you any more precision. I mean, here's that great trade. And we don't need it. We've got our quant line. We've got our background bias. The candles outlined in order flow. Both MACD's lines are to the upside. One's blue and one's green. But I can tell you it just doesn't have any value. Take a look at this move up. Now, this isn't an entry. But you would think that this line is red. It might tell you, well, you're not going to enter on this candle because one of the MACD lines assimilating data from 2 higher time frames is red. Forget it. The market just goes right up. Now we're going to forward test this over the weekend, but I can just in looking at it, it just doesn't work. And it's another nail in the coffin of the MACD system. And we don't just do a MACD, we do a MACD. We're looking at 4 separate MACDs. And it's easy to do when you just have the MACD crosses. When they're both crossed to the downside, red, both crossed to the upside, green, or blue and yellow. And I haven't given this out to anybody yet because I don't like to clutter our chart with entries that don't increase the positive predictive value of our trading. I mean, why make people assimilate more information that doesn't provide them with better trading entries? And since this doesn't, we're more than likely just going to boot it and throw it out. But it was an attempt to leverage the MACD system in a way that helped us trade. And what we found was it's just not helpful. You know, it's what I anticipated. It's what I believed. It's what I saw from trading from using the MACD on 1 time frame, and and now it's borne out by using the MACD on 4 time frames. So the goal of the trading system and the algorithmic, just let me say one other thing quickly. I don't want to run over the hour because I know I don't want people to get bored. But here's the problem when you trade on a discretionary basis. And let me just bring back a chart. Now, defining 2 independent variables as a trading entry is all well and good. But which independent variable has the most power? In other words, we know, and we have an indicator which tells you how far the candle open. We know that the further away the candle open is from support or resistance, the more likely the trade is to fail. 4 ticks off support or resistance makes the probability too high that the trade will just retrace back and then go up. It'll stop you out and then move. So that's one independent variable. You're sitting right on support. And you could be as much as 4 ticks off. And if you look at the right edge, we have an indicator. See the 0? This tells you that the 0 is right on the modified 15. The candle open is no ticks off. So we built an indicator to define that independent variable. Another independent variable is background bias. We want really the tan or the pink to take a short. Algorithmic system will only trade with pink. Now we have 2 independent variables. Well, which independent variable has the most power? And you know what? There is no answer to that, because in different markets, different independent variables get different weights. And there is no way to there's no way to back test it. So that's one of the problems with discretionary trading. There's a nonlinear relationship between independent variables. And that's why a professional day trader who does well for 30 months can go into a period where it becomes difficult to trade. It's because some of these independent variables have shifted in weight. And what you have to do after every market is sit down and look at your entries and try to define what it is about the trades that you're taking that are causing you to fail, that are causing you to become to lose your profitability and lose your edge. Now, in a quant system, an algorithmic system, because it's so conservative, the nonlinearity of these independent variables have no impact on the outcome. And that's a real strong suit of machine-generated trading. And I'll tell you, I believe that in the future, algorithmic trading is going to become the primary way that people day trade. Now, we have a very powerful algorithmic system, and it's going to get only better. And it's going to come at some point where it's so good. And remember, it factors out impatience. It factors out loss of discipline. It factors out that itchy trigger finger to take a trade on with a non-optimal market setup. It factors out boredom. It factors all these things out. It just sits there. And if you looked at one of the emails I sent out, we are programmed based on our DNA to fail day trading, because we're programmed to want to get every winning trade. We're not programmed to sit on our hands. If we see a 25 or 30 tick move on crude, we want to be in it, and we get aggravated when we're not. And that aggravation extends out, and we start to look for trades, and we start to lose our discipline, and we start to take trades that don't have the predictive value that we want. Well, that's what the quant system factors out. The human element, which unfortunately, based on the way we needed to survive, works against us really hard when we day trade. It takes a lot of patience to sit on your hands during a time when the market maybe for 2 or 3 hours doesn't give you an optimal entry. It's difficult. And it's difficult after a 30-tick move to not start hunting for a winner even harder and maybe jump in a little bit too quick because you just missed a gigantic move. And you didn't miss it. There was just no trading entry based upon our strategy. And when you trade with precision, the object of trading with precision is when you take a trade, it wins. But if you trade with specificity, which is precision, there are going to be trades that go significant distances that you just can't get in. So we don't care about the winning trades we don't get in. We care about the losing trades we avoid. And that's our strategy. Now, basically, our overall strategy here is we don't trade tops or bottoms. Now, if you know the mathematics of these indicators, I see it advertised all the time. We call tops, we call bottoms. It is not mathematically possible to call a top or a bottom. I already showed you the irrelevance of an oscillator. Trust me, if you try to use an oscillator to call a top or a bottom, you're going to get run over time after time after time. In fact, our system is based on the fact that people try to call tops and bottoms, and we run over them. And they're forever going to be doing it. I can give you a great example. It's right here. Look at all the people or all the traders in this candle to this red candle or the orange candle to the downside. Whoops, just put that up by mistake here. I mean, why the heck would anyone want to go short and try to decide that this is the market high and take this to the short side? I don't know. But there's enough people in this candle to create a 4-tick candle body with only a tick a wick. And what we do is we go long, we run them over, and we go to the upside. So the way we trade is always to take advantage of people counter trend trading and trying to call tops and bottoms. And you're just never going to do it. And I see it advertised all the time. You know, we'll call tops for you. We'll call bottoms for you. You know, you can counter trend trade. Well, remember who makes the trend. The trend is set up by the institutions. And remember, what we want to do is we want to beat out the other commercial traders and always trend trade, because we want to trade with the big boys, and these guys who can throw out 3,000, 4,000 contracts in a move, we can never beat. We always want to be with them. So we don't trade potential reversals, which is another way of saying tops or bottoms. We never counter trend trade, because counter trend trading is going against the big money. And we do not trade potential breakouts. If you know the math of these indicators, there's no way they can tell you when a move that's maybe gone, a candle and a half, is going to continue or it's not going to continue. And I'll tell you, most breakout software is based on MACD and oscillators. So you can see that since a MACD and an oscillator don't even work, trading potential breakout systems is a disaster and it will bust you. The only thing you can safely trade are retracements in a multi-time frame confirmed trend with multi-time frame market structure and alignment. That's the only system that I have ever found that works. It doesn't mean that there are other systems out there that don't work. It is that I've never seen one. You have to have multiple time frames in alignment. You have to have appropriate market structure. Since you can't predict a breakout, i.e. a continuation trade, you have to take a pullback and then a continuation trade in that manner. It's the only way that you can trade with specificity approaching 90% or positive predictive value of 85% or greater, and that's the win percentage. That's what the algorithmic system does, and it does it dispassionately. And sometimes there'll be 2 or 3 days without a trade, and like today we had 2 nice trades that I blew off the charts because of the fact I rolled natural gas forward, which is a really stupid thing to do. I just sort of clicked it out and left it down for the day, and in rolling it over, I dropped every market for the day. And these are just some examples of discretionary trades, and basically they're all the kind of trades I showed you. Here's the conservative retracement, triple quants, dark background bias, multiple markets aligned to the downside, all resistance, all support to the downside is broken. All the quantitative markets are telling you that money is flowing out of the E-mini. And we took this trade that went 19 ticks, 4.75 points. This is the kind of trade the algorithmic system is going to be right in on. This is the kind of trade that's going to be to the upside. All the quants showing that money is flowing into the markets. We've got a pullback right to support, and up you go. This went 3.75 points. Again, to the downside. All the quants red, 3.5 points. And we use our NDT. I'm not really going to go into that. It's a patent pending execution platform. It's part of the algorithmic system. This is what received the signals from our server in Chicago. It's really a terrific tool. I'm just going to skip that. Now, normally the algorithmic system is $3.99 lifetime. The special lifetime is $34.99. Our other special is it's $3.99 a month. You can get it if you pay for 2 months. You get a third month free, and within the first 30 days, if you like the system so much, you can actually apply the $7.98 to the cost of the system, which will be $34.99. So you essentially would get a free month because you roll it over, it drops the price of the special lifetime, and you've got that first month, and you really don't pay for it. So that's really it. Let me just quickly take a look at questions and see if I can answer them. 1 second here. Okay. There aren't that many. Yeah, David. Well, David left. Let me see here. The reason we only have a few weeks, Tony says, why do you only have a few weeks of trades, is because the algorithmic system is new, and we're just ramping it up. That's really why. It's only been operational for 6 weeks, and the first 3 weeks it was on. It only traded the E-mini and the crude, and I trade those, and I was into those. The monthly lease is $3.99. Hold on 1 second here. Yeah, it was gold, Heinz, correct. What time frame do you run the algo? I run it at Walter at the time I'm in the room, because I like to watch the trades. It's usually from 8:45 in the morning to between 11:30 and 12 in the afternoon. Now we're experimenting with letting it run all day. We have it optimized for the morning hours because volume is the highest, and we don't want anything to run. You know, in lousy volume, market sentiment, which is really what the indicators are, become less valid. But we may let the algorithmic system run all day. So that's the on-off, Keith. And same thing. It's a complete auto trader, Larry. It's not really an auto trader; it's an algorithmic trade. But the system is, gets you into the trade. It's self-adjusting and determines your targets and sets your stop. And the monthly lease is $3.99. Yep, it does, Frank. It manages everything. And again, Larry, 8:45. $3.99 for this special is for all the markets. Normally, it's $3.99 per 2 markets. For this, you're going to get $3.99, and you're going to get every single market. Well, Alan, we plan on going to the euro, we plan on going to the Forex. So we'll be running at night because we're going to trade the algorithmic system on the European Forex session. So it's going to run from 2 a.m. or it might be 3 a.m. With Eastern, it's Eastern daylight now, but it's going to trade the European Forex session. So it will run at night. We run all markets at the same time, Walter, and we trade 4 contracts. 4 contracts per instrument. Now, here's the thing. Initially, we censored it so that it would only put you in 1 trade at a time. But what we found was we recently had a trade on notes and bonds that clicked in within, I don't know, a few seconds of each other, and we let it go. And if it overdrives the margin in your account, the second trade will simply come in as an error. But there's a lot of people on the system that we see, because we have to know how many contracts you want to trade in order for us to program it for you. So just hold on 1 sec, Heinz. I'll answer. So we know a lot of people are trading big lots, 25 lot on the E-mini. So we're going to let it run, and if it gets to 3, if it gets you into 3 trades at the same time, and you have the margin to cover it, you're going to be in all 3. It will not censor a trade. The only thing it will censor is a trade that I'm in. If I've already taken it discretionarily, it will not click an algorithmic entry on a trade we're already in on a discretionary basis. But if 3 algorithmic trades hit within a minute of each other, you're going to be in all 3. Okay, I didn't know that it was now $5 a tick, the 6E. But that's the next market we're going to be on. We've already forward tested it, and we are going to be adding it very, very shortly. It's a great market for us. And that's one instrument that we may turn on much earlier in the morning, because the time that we forward tested it started at 6 a.m. Eastern. It's got great volume early in the morning. So the 6E may be a market in which we turn the whole system on, and we recommend that you maybe only enable the 6E. We're going to the Forex futures. We're looking right now at the euro yen, the euro pound, and the euro dollar, trading the European session. And it looks very good. Absolutely, Walter. You can decide which markets you decide which markets you want to trade. You have to enable the system market by market. Well, listen, the DAX and the FTSE are just a little bit off, Heinz. I love the DAX. We're going to get to it, and we're going to add it. You need about $5,000 to fund the account. Remember, your maximum margin is going to be $4,000 on 4 contracts on crude and gold. And it's very unlikely to take a loser, but it's listen, it happened 4 times, but you're very likely to get a drawdown because we really had 22 winners and 4 losers. I blew the 2 winners today on gold. Well, hey, listen, margin on the DAX, Heinz, is definitely bigger. If you want to trade the DAX, you're going to need much, much more money. I totally agree with you. It's one of the problems that needs to be overcome. If you want to trade the DAX, which is a great market, you're going to need a lot more money. But for trading the markets we're on right now, between 5,000 and 5,500 is all you need. So listen, if you have any other questions, just give us a call in the office. Rory's going to be here for another hour. Yeah, it's 2,000 for the DAX. Yeah, margin's just really big on the DAX. And if you want to trade 4 contracts, you're going to need about 8 to 10 grand. So, a margin. So, in fact, you're going to need at least 10,000. We're going to send the links out in about 5 minutes, Heinz. We're going to send them out to everybody who's in this webinar. So you're going to get the links very, very shortly. Just hang on. They're coming out to you. So listen, everyone, because they're not on the website. The website will show you. Thank you very much, Robert. You'll see that 2 markets are $3.99 a month, and the only way to get all the markets is to buy the system lifetime, and the lifetime is $5,999 now, because we're going to go to more and more markets. And if you have a lifetime subscription, you're going to get all those markets. You're going to get the DAX, you're going to get the Forex, you're going to get them all. So the price is high, but let me tell you, the return on investment with this system is exceedingly high. So we'll have the links out. We also welcome everyone into the trading room for a free trial. We'll send you that link too. The algorithmic system is really, really terrific. And we're working on it all the time to make it better. Remember, the optimization of a absolutely, you always get upgrades for free. We never charge for that. And I know there's a mini DAX now too, Scott. I know that. And we're going to look at all those. We really haven't turned our sights on that yet. Listen, we're in the process of developing a dashboard that is going to be, I hate to say this, is going to be so powerful. It's going to blow the pants off of everybody, because we have the independent variables down. We're going to create a dashboard that's going to show you in an unbelievable number of markets when to pull that market up and when to watch it. And it is really going to be an incredible ancillary trading tool. And that's the tool we want to get out next. And it's going to be called our dashboard, but it's going to read for us all of the, it's like a market analyzer. Yeah, we do, Heinz, and we're going to send those out. We're developing a market analyzer, Heinz. That's what we're doing right now. And just by looking at that analyzer or dashboard, you're going to know. We don't believe, since this is a discretionary system, we're not going to have the market analyzer give you an entry, but it's going to tell you when you should look at a market because you have an alignment of all the independent variables that we know go into making a successful trade. Then all you got to do is bring it up and watch. You may get a great entry and you may not, but you're not going to be spending a lot of time watching crude oil when the MA diff is 40 and it's massively overbought and spending 35 minutes waiting for it to retrace. Every minute that you spend day trading, you're going to be looking at markets that have the potential to give you a great entry. And that dashboard is really going to optimize your ability to get into those successful trades on as many as 12 markets. And it's up to you which ones you want to trade. We're going to put them in the dashboard. And because it's a discretionary system, you trade the markets you like, you don't trade the markets you don't like. And we're going to be using it in the trading room. I mean, those are the ones we are going to count for our net equity. Well, listen, I love this tool. This tool is a killer because we have a little bit of it in beta testing available, and it's amazing. I mean, when the quants are green, you see it on the dashboard. When the 50's green, the 15's green. You see all this stuff on the dashboard, and you turn to the market. You may not get a trade, but you're going to have a high likelihood for one coming up. And you may have to drop the market because it just doesn't materialize, but you're always looking at markets with the potential for great entries. And that's really where you want to be. You want to be where the action is. You can't have 12 markets up in front of you. Your brain will fry, but you can have the dashboard up and simply bring the market up that is likely to give you a great entry. And that's what the dashboard is going to be all about. And that's going to take us only another 2 weeks. We're going to have that available. So listen, everyone, have a great evening. None, Tony. We're going to enable it for the NT8. So it will not be a problem. We're working on that right now. Right now, we do not. You can't use the NT8 yet, but we have the NT8, and we're working on making the upgrades. Very shortly, the NT8 will be fine. And that's a really good question, too, by the way. Thank you, Tony. All right, everybody, have a really, really great afternoon, evening. Thanks for giving me your time. We'll send you out the links. Any questions, just call the office. We're going to be here for another hour. I really do appreciate your stopping by. Take care. Have a really, really great evening. Bye-bye. Thank you all. Thank you, guys. Appreciate it. Bye-bye.